can I offer you an apology?
Spare me. I backed you. And then I watched your naivety play out in slow motion.
Maybe we can ride this out.
How many off-book meetings did you have with tender management? How many times did the mucks pick up the tab? How frequently are you recorded as being in their offices or their home? Make no mistake, if this flares up anymore, they'll throw a body overboard before politics hour, and your answer to those questions is more damning than mine.
Hi, my name's Alastair Matchett. I'm an ex-investment banker. I worked in private equity. We're here to do a review of industry, and we're looking at series 4, episode 7, which is called Points of Emphasis. And this is where the tender debacle is really starting to implode. So we're going to go through the program, review some of the terminology and jargon used, and give you a bit of an explainer. So let's jump in.
It snapped back. Tender's up almost 10% already.
They've issued another press release of Tony Day's denials in writing.
Anything new in it?
Claims are baseless and misleading and do not represent the company's financial reality. The company maintains a robust internal framework. I mean, this shit is literally designed to make any reader glaze over.
Yeah, everything is a rehash at this point.
Anything about a new audit?
No, just affirmations of the results of previous ones.
Okay, so we hold the line until a new one is confirmed.
Yeah, well, who's forcing them into that? Without another audit, we're dead in the water.
So in this scene, we've got Harper's team reviewing their position in Tender. Now, Tender's stock has bounced back, and that means there's been a 10% uplift. Now, in the last episode that I covered, the numbers really didn't seem to stack up, but here at least they seem reasonable because they've got $147 million short, and that's their position. So they have sold $147 million of Tender shares. Now, if Tender's share price has risen by 10%, it means they've got to spend 10% more than 147 million buying back the stock. So 10% of 147 million is around 15 million. They've got a loss of 16 million, and I guess that embeds things like borrowing costs, etc., which is why it's a bit higher. But this is certainly a lot better than the last episode in terms of their financial position.
Without another audit, we're dead in the water.
Well, I mean, maybe it's time we meditate on how we catalyze the audit that kills them.
What would Eric's take be on that?
How should I know? He decided not to be here.
So in this scene, Harper makes a famous quote on how they're going to meditate on how to catalyze the audit that will kill Tender. I think I really just wanted to mention that my experience of people doing fundamental research in hedge funds is it's a very analytical, careful, thoughtful process. And you wouldn't kind of meditate on something happening. It would be a very clear analytical process with clear probabilities of things happening. So I think this is a little unrealistic, and it's definitely kind of zhuzhed up to get the drama effect of this program.
I've been thinking about going to the authorities all night. Why shouldn't I?
You already know why you didn't go or you would have gone.
I'm an accessory.
You're the face of the company.
An accomplice.
Fraud, embezzlement, market manipulation. Hire the cream of the legal crop. You're not escaping jail time, Henry.
So, why write me that letter?
Think of the optics if my CEO went AWOL now. Besides, we're close enough for honesty.
Fuck yourself.
Everything we have done since we partnered has been true. Why let them rob us of our glory for what was at the time necessary balance sheet imagination? Our share price will continue to recover. Tender 2.0 has successfully transitioned us into real revenue and phased out inflated third-party acquisition flows.
Fake. Do you start using the fucking word? Fake. I watched Stern's presentation. Which part of it was wrong? Exactly.
It's simply a misalignment between the velocity of my vision and the velocity of regulation, and that gap is where smart people have always made money.
So in this scene, you've got Whitney saying to Henry, hey, you're going to go to jail, mate, unless you do what I say. And this reflects exactly what happened to Wirecard, the German payments company. And in that case, their CEO, Markus Braun, was done for a number of things: aggravated fraud, falsifying financial statements, breach of trust, and market manipulation. So this is very, very similar to what Whitney's saying. He says fraud, embezzlement, market manipulation. So it's pretty much on the money of what Henry could be done for here. And that's been reflected in real life, in real examples, in the case of Wirecard.
We have to buy time. Make a clean audit as protracted a process as possible. Delay and complicate until some of our overrepresented cash flows can be swallowed by a much larger balance sheet.
How?
Targeted acquisition. Hostile takeover.
Because it's as simple as saying that, right? How the fuck would that even work?
In this scene, Whitney's talking about getting out of this terrible situation with Tender by making an acquisition of Pierpoint. And that's probably stretching the possibilities that could actually happen in real life. I get what he's saying. He's saying basically if we acquire a much larger company and they do an audit, in an audit, if they find irregularities, if they're immaterial, and the test of immateriality in an audit is not increasing or decreasing net income by about 5%, then they can kind of get ignored or maybe reference them, but it's not going to make a material difference to the performance of the company. So that's the idea behind making an acquisition of a much larger company, is that these irregularities will become so small that they're deemed immaterial. Now, they're talking about hostile takeover. Let me just give you a little bit of background to exactly what that means. So in a public situation where you have a publicly traded company and you want to make a bid for that company, there's lots and lots of rules about thresholds. So as soon as you go over a 5% ownership of a company, and that can be direct, owning the shares directly, or borrowing the shares, or having some synthetic investment through options, you will need to disclose to the market that you own 5%. And then there are more thresholds, and there's a key threshold at 30%, which means you need to make a full bid for the company. So it's actually quite difficult to kind of build a stake in a company secretly, which is potentially what they've said they've done, which I think is a bit unrealistic, because you generally would need to disclose that to the markets. And there's a lot, certainly in the UK, there's lots of rules about that, and in the United States too. Now, you can, nevertheless, even if you haven't built a stake, make a bid for a company. And you can make an announcement saying, we're going to offer shareholders, write to all the shareholders, and we're going to offer X dollars per share. Now, if you haven't agreed that with the board of directors of the target, which in this case would be Pierpoint, that will be deemed a hostile takeover because you haven't actually talked to the management team, agreed a transaction, and then come out together saying, hey, we have agreed that Pierpoint can be acquired for 1.9 times book, and we're going to ask all the shareholders to vote on this transaction. That will be like a friendly takeover where you have the both boards of directors recommending the transaction. However, if the target company, in this case Pierpoint, don't recommend the deal, then it is a hostile takeover. It will be an unfriendly takeover. So for it to be a hostile takeover, you have to have a situation where the board of the target company is not recommending it.
A few months ago, when you said we should increase our stake in Pierpoint, I used Cayman and Luxembourg SPVs to build an undisclosed synthetic position to buy shares in Pierpoint.
So in this scene, we've got Whitney saying that he has built an undisclosed position in Pierpoint. Now, under the UK disclosure guidance and transparency rules, if you hit a 3% threshold ownership of a company, public company, then you need to disclose it to the market. And that ownership doesn't mean just directly in the shares, it can mean a synthetic ownership. And that can be via equity derivatives. So you can buy calls options, the ability to buy shares, or you can borrow shares, all those kind of things. They will get factored into your ownership percentage. So the idea that you can build an undisclosed position legally is not true. Now, of course, you can potentially do this illegally by having side agreements. And what he said is that he has done this through SPVs in the Cayman Islands and Luxembourg. Now, the reason people use Cayman Islands and Luxembourg is traditionally for tax reasons and low cost. So they're putting a special purpose vehicle, which is essentially a corporation or sometimes a trust. And that corporation is kind of a shell company, and that will own securities on somebody else's behalf. And they will then have an interest in the special purpose vehicle. So essentially a special purpose vehicle is typically a corporation set up to do a particular purchase of an asset. And they're used in things like project finance. So they're extensively used in finance, and they're usually corporations. They can sometimes be trusts as well. But here, Whitney is saying that he has set up some special purpose vehicles in Luxembourg, these low tax jurisdictions, and the Cayman Islands, and then has used those to build a synthetic position, typically through derivatives. And that could be a CFD, which stands for a contract for differences, or it could be equity derivatives. And this will be illegal because if he has built a position above 3%, then that should be disclosed to the stock exchange authorities.
This is how it's going to play. We say, due to a transformational merger, any audit must reflect pro forma consolidation. We need to hire more advisors. Since you unwisely fired my auditor of choice, we have to add intermediaries, add complexity to the jurisdictional fog of who audits us, plus the media smokescreen of a turbo bullish headline.
I don't think there's a single person on earth who thinks like that in this scenario.
No, you're lucky you have me.
So here they're talking about a pro forma consolidation. Let me explain what pro forma means. When someone says pro forma, it comes from the Latin. It means kind of as if they were together. So what investors will want to see if, in this case, Tender acquired Pierpoint, is what would the combined financials look like, both particularly in a forecast basis. So they'll take the equity research forecasts for Tender and equity research forecasts for Pierpoint and mush them together as though they were one company. And those would be termed the pro forma financials. Now, in the financial statements, they also will do that on a historical basis as well. They'll take the last year or the year that the deal happened and said, if we had been together for this year, the pro forma financials would look like this. So it's kind of as if they were together. That's what that means, the pro forma consolidation. So they do the numbers as though the business has been together in the year of the deal and going forward. And that gives an investors a better understanding of what the combined entity will look like.
It is clearly in the public interest to understand what position Tender is now in and what risk it might now pose.
Agreed. So let's ask the Secretary of State to just explain the nature of her interactions with Tender senior management.
Sebastian, as a former entrepreneur yourself, you well know that ministers routinely meet with a large number of business leaders, stakeholders, and industry representatives. All such meetings are conducted in line with the ministerial code, and they are properly recorded in transparency returns.
But people are saying that you and your department were in bed with Tender senior management and expedited their licenses and approvals in search of good headlines.
Expediting licenses, I mean, that is a serious allegation you're making against the minister personally there.
Yes, do you have proof? Is what you're saying is a deliberate inflammation of totally normal practice.
So you are in bed with them?
Look, I'm not in bed with anyone apart from my husband. Sorry, you
almost have a scoop there.
Yeah.
So in this scene, they're talking about expediting licenses. And what this means is banking licenses. So in order to be a bank in most jurisdictions like the UK and the US, you need to have a license from the regulator, which in the UK is the Bank of England. In the US, it's the Federal Reserve. And those licenses allow you to take deposits. So that's the key thing which differentiates a bank from many other financial institutions, in that they're allowed to take deposits from customers and then take those deposits and then lend them out. And it's quite a big deal to be a license as a bank. And there will be lots of checks and due diligence done on people getting banking licenses. Not only just their character, but also do they have enough capital to support a kind of a headroom or a kind of cushion that if your loan book declines in value, you've got enough money to pay back the depositors.
Good afternoon, everyone. We want to launch stock-for-stock hostile takeover of Pierpoint ahead of their AGM this week.
Tenacious.
Henry and I can jump on a flight tonight. Our stock continues to rally, so we'll be trading at a premium to Pierpoint.
I don't understand why we aren't privileging a new audit. We have nothing to hide. If there are no skeletons in the closet, why not open the closet?
I imagine there is a time sensitivity issue. Also a confidentiality issue around disclosure of valuations and the deal terms.
Henry, you're Whitney's chosen man. Is he making the right call here?
Fuck's sake, Henry.
Tell them how passionately you lobby me for this as a fearless leader and CEO.
So in this scene, they're talking about a stock-for-stock takeover. There's a couple of different ways in which you can fund an acquisition. In the case of financial institutions, they generally don't have a lot of cash sitting around on their balance sheet because they've typically lent it out to people who want to borrow money, because that's their business model. So in this case, a stock-for-stock acquisition would be tender, literally sending share certificates. I mean, it's not done actually physically, it's done electronically now, but they'd send share certificates to all the Pierpoint shareholders, and there'll be some kind of exchange and some number of shares for each share in Pierpoint. So they'll get a number of tender share certificates for each share in Pierpoint, depending on the relative share prices. And then the Pierpoint shareholders would send their share certificates back to tender, who would now be the owners of those share certificates and be a subsidiary. So this means that the Pierpoint shareholders will end up as tender shareholders post-deal. No cash changes hands, it's just share certificates. So Pierpoint shareholders hand over their share certificates to tender, and tender then hands over their share certificates to Pierpoint shareholders. Now, in reality, that's all done electronically rather than physically. Now, what will happen is that there will need to be a resolution at the board level to approve this takeover if it's a friendly takeover. And they're also talking about tender trading at a premium to Pierpoint. Now, that's a really important issue in a stock-for-stock acquisition. And what they're talking about here is the relative multiple that the two firms are trading at. And for banks, we can use price earnings multiples, which is the share price divided by EPS. But more commonly for banks, what we do is we take the market capitalization, which is the overall value of the shares in the financial stock market, divided by the tangible book value. And what that means is the shareholders' equity on the balance sheet of the bank, which is how much shareholders have actually invested directly in the bank, less any intangible assets like goodwill and other intangibles. So that's the market capitalization divided by the tangible book equity. And that's how we typically value banks. And what this means is if tender is trading at a premium to Pierpoint, then let's say tender is trading at 2 times book value or tangible book value, and Pierpoint would be trading at, let's say, 1.5 times book value. So this means tender has a higher value per dollar of shareholders' equity than Pierpoint does. So that means it's much easier to make an acquisition because you can kind of pay a premium because your shares are more highly valued. In this case, tender shares are more highly valued than Pierpoint. So they want to get board meeting approval, because if the board approves an offer by tender, then it becomes a friendly transaction, and that's generally a much easier thing to sell to shareholders than if it's a hostile takeover. So in this case, they're talking about actually doing a friendly deal rather than doing a hostile takeover. And they're talking about the fact that tender's trading at a higher multiple than Pierpoint.
Yeah?
Wilhelmina, we're on our way to see you.
I'm warning you, I am getting a huge amount of blowback about the tender headlines. We prep for tomorrow's AGM.
There's rumors of an Almirage term sheet floating around where it is you're being sold. Clean structure, laughable leverage ratio.
That is not entirely inaccurate.
What are they pricing you at? 1.2 times book and 90-day clawback window?
You're not far off. The pricing is to go.
Well, let's speed it along for you.
Now in this scene, they're talking about the Almirage term sheet flying around. Now a term sheet is a relatively short document which summarizes the key points of a financing or an acquisition. And it kind of literally lays out for investors in very simple terms in a short document what the overall deal looks like. And in this case, they're talking about Almirage selling their stake in Pierpoint. And they are pricing it at 1.2 times book. And as I mentioned earlier, this is 1.2 times the shareholders' equity on the balance sheet of Pierpoint. And that typically will be done as a tangible shareholders' equity rather than just simple shareholders' equity, for reasons I'm not going to go into here. But they also talked about a 90-day clawback window. So a clawback window is typically linked to some type of breach or accounting adjustment from the transaction. So what this probably means is that part of the consideration can be clawed back by the buyers of the business for 90 days if they find something that is materially changes what they expected to find in the business. They don't really specify what it is here, but that's kind of what it relates to. It's where if Almirage sells a stake to another investor, that investor has a 90-day window to be able to claw back some of the money that they paid, depending on due diligence that they did after the deal closes. Because in a public company, you can't do due diligence prior to closing. You have to do due diligence when you bought the company. And that's probably why they have a clawback window in this case.
We could be a transatlantic giant.
You're not buying a fucking lollipop, for Christ's sakes. There's stakeholder optics, governance, a process.
Then give the floor to me.
Well, how do you mean, at the AGM? You have no formal standing.
You have the power to cede the floor to me under special motion.
You're not a stakeholder of record.
It should be known that we're holding Pierpoint stock under a number of nominee structures, and we're an important strategic partner. I don't have to be noisy about price suppression or, God forbid, talk about the undeclared sovereign wealth in your recap structure.
What, that doesn't exist?
Well, me saying it's almost as bad as it existing. Or I could leak my counter-evaluation to the press, or worse, say that Almirage is a distressed seller in no position to make a strategic exit.
So in this scene, you've got Whitney talking to the CEO of Pierpoint, and they're talking about the AGM. And Whitney wants to make an announcement of this offer for Pierpoint at the AGM. And they're talking about, well, you're not a shareholder record, and you need a motion to do this. And in a AGM, there will be standard motions, like you'll go through the financial accounts, you'll update on strategy, you'll vote for the board members to be reinstated, things like that. And then you will have things like special motions. So that's pretty reasonable to have a special motion, certainly to do with an acquisition. Now, again, in this case, they're talking about they are a stakeholder record, but it's kind of secret. We haven't announced it to the market. That is illegal. And certainly the CEO in this case would say, well, that's completely illegal not to have disclosed that. You should do it even if it's not direct. It's done through nominee accounts or it's done through equity derivatives. So that's relatively unrealistic. Then they're going on to talk about a recapitalization structure, or what they shorten to a recap structure. And this is where Pierpoint, if it's short of shareholders' equity, in other words, regulators, when they're looking at banks, will say, okay, you've got three main parts of your balance sheet. You've got your depositors' cash and you've got your loan book. And generally speaking, the loan book will be bigger than the depositors' cash because the difference will be the shareholders' equities, the money the shareholders have given the bank, either directly through a share issuance or by earnings that have been reinvested in the bank. And the regulators will require that certain amount of cushion in the shareholders' equity. So if the loan book declines in value, there's enough kind of cushion or headroom that can absorb those losses before depositors are affected. Now, in some cases, that cushion can get pretty small, and that's where the regulators will require a bank to recapitalize its balance sheet. So in this case, clearly, Pierpoint is worried about its capital ratios, and it's thinking we need to raise more equity capital from investors. In this case, they're talking about a sovereign wealth fund, an undeclared sovereign wealth fund in this recapitalization structure. And they don't mention who it is, but he's suggesting that that's not necessarily really true. And again, it would be really unusual to announce a hostile takeover at an AGM because you've got to have the management team giving you a special motion, and they would never do that if it was hostile. So if you can do a hostile takeover, you just basically send an offer to shareholders, publicly announce an offer to shareholders. You wouldn't need to go to the AGM to do that. So it's a bit unrealistic. So the only reason you would want to have a special motion at the AGM is not to have a hostile takeover and have it as a friendly deal, but you would normally negotiate with the board of directors, the management team, before you do that to get an agreed deal that's friendly and then announce it. Now again, you probably wouldn't announce it at an AGM. You would normally do a kind of press release and offer to shareholders. So it's a kind of slightly unrealistic situation. And they're also flying this private jet to Newark, which kind of is a little unusual unless it's a very large private jet. Most of the private jets going into New York will go into Teterboro Airport, which is a small airport pretty close to Manhattan.
We remain well capitalized with a core Tier 1 capital ratio of 10.3%.
Not feeling myself.
Now, as ever, I would like to
I
close
don't think
my
I can do
remarks
this.
by
Yeah.
saying that we at Analyst Pierpoint pride ourselves on
I
our
can't.
proximity to regulators.
So here they're talking about a well-capitalized bank, and this relates to this Pierpoint capital issue, the difference between the loan book and depositors being the shareholders' equity. And the Tier 1 capital ratio, which is a key ratio illustrating the kind of safety of banks, they're talking about 10.3%. And that's calculated very broadly speaking by taking the shareholders' equity on the balance sheet, less things like intangibles, tangible assets, and dividing that by the whole asset book, but weighted according to its risk. So the really low risk assets like cash and short-term government bonds will be rated at 0%. And then you have a varying grade of weighting according to how risky the asset is. So they'll take the tangible shareholders' equity divided by the risk-weighted assets, and they'll come up with these percentages of 10.3%. So broadly speaking, what that means is that 10% of the asset book is funded by shareholders' funds in a very, very rough sense.
We want to be US dollar natives again. Our offer for Pierpoint is 1.9 times book. Peers trade closer to 1.3 times, so why the hell the premium? It is a display of faith in what we believe this union to be. A marriage, balance sheets, regulatory infrastructure, trust. The offer is 90% stock.
Your stock is too volatile. This man should not be heard. He isn't serious.
Your company is falling apart.
Fake news. Detractors have been at door since jump for being too early, too fast, too big. Railroad to the internet. History of industry in this country is pockmarked by a slew of disinformation from those who don't stand to benefit from radical thought or the displacement of worn-out structures.
More bullshit.
Mr. Habslam offer must be heard. Please continue.
Thank you. The offer is mostly stock for stock. By year one, we expect it to be earnings accretive. By year two, this thing's gonna be paying for itself through capital efficiency and operational overlap. I'll leave you with the words that every industrialist had sown into their souls at every point in the last century. We want speed. We want scale. We want certainty. We want America.
Now in this scene, they're talking about the offer for Pierpoint, and they're saying we're going to offer you 1.9 times book value, which is 1.9 times shareholders' equity, usually after deducting intangible assets, or what they call tangible book value. And that's a pretty strong offer. A bank trading at 2 times book, that's a really high valuation. And the peer group, they're saying, is trading at 1.3 times tangible book value. And that will be a more normal valuation for banks. In the financial crisis, most of them were trading below 1, which suggests that actually the market value of the equity is lower than the balance sheet value. And that suggests that they should liquidate. But that was an unusual time because of the financial crisis. And they're talking about the deal being accretive in year one. What that means is you have the pre-forecasted earnings done by research analysts for both companies, for Pierpoint and Tender. And they will forecast the earnings per share, and they have no understanding that the deal's happening when they're forecasting the earnings per share. If you then combine the financials as one company to be accretive, what it means that Tender's earnings per share before the acquisition is lower than the forecast earnings per share or the pro forma earnings per share after the acquisition. So what this means is if it's accretive, let's say Tender has a earnings per share of £1.50 in the next forecast year. If it's accretive, then the investors need to know that the EPS will go to, let's say, £1.60. It will be higher than previously forecast. And that means it's an accretive deal. And then they give a whole load of BS about things like capital efficiency, overlap, paying for itself. This is all baloney. an acquisition like this doesn't pay for itself in a couple of years. That's just bonkers. Generally speaking, in bank mergers, it will all be about cost control, stripping out cost, reducing cost, which gives us cost synergies, which means that will drive up the earnings per share forecast. There may be situations where you have a strategic player where one financial institution has very good, let's say, payments technology, but generally speaking, in bank mergers, it's all about kind of cost control. And you will also have to get a regulatory approval for things like bank mergers too.
Henry, it's Wilhelmina Fassbinder from Almirage Pierpoint. I owe you the call, not Whitney, given my reservations about his character. To be blunt, I allowed his little charade at our AGM to jack up our sale to Temasek. It had been in the works for some time, and his proclamations about our valuation gave me a little leverage for the final negotiation.
Okay, have you spoken to Whitney at all?
I haven't. Although I hope you realize his yarn about buying multiple positions at Pierpoint was a bluff. I called his supposed intermediaries. There's no term sheets, no interbank confirmation, no capital. There's no record at all, nothing. Snake oil and sermons sound similar, don't they? We will all be monitoring the tender fallout closely. If your equity continues to crater, we'll trigger the conversion on your bond. And we will be pursuing full recovery so that our institution doesn't suffer. Good luck.
Now in this scene, you've got Wilhelmina Fassbinder from Pierpoint basically shooting back to Whitney. And what she quite cleverly did is that she allowed all that process. She allowed Tender to make this kind of crazy offer at the AGM, 1.9 times book, which is really high, to essentially jack up the valuation of an offer from another counterparty she was talking to, which is Temasek. And Temasek is a large Singapore-based fund. It kind of has characteristics of a sovereign wealth fund. It's not technically a sovereign wealth fund. It's a big asset manager, and they are basically buying a stake in Pierpoint, probably buying some of the stake from Almirage, who is trying to sell their stake. And she did this, she did allow Tender to make this offer to make sure that Temasek will potentially increase their offer. So essentially a really big bluff by the CEO of Pierpoint to try and jack up the price. She then goes on to say, and Tender, we have a CoCo bond outstanding, and that's a contingent convertible bond. So it's currently a bond, but there's certain things that will trigger the bond to be converted to shareholders' equity. Now, you don't always necessarily want it to convert. That's a slightly weird thing, because usually a CoCo will convert when bad things happen. So in most cases, investors won't want the contingent convertible to be triggered, because it means that they, instead of having a bond, which is a senior position in the capital structure, they end up with shareholders' equity. And they'll end up with shareholders' equity in a firm that is in distress, which is not a great place to be. So I don't think it's very realistic that she would want to trigger conversion. She may want to call the bond to get it repaid, but I wouldn't think she would want to convert the bond, because normally the bond will convert in a situation of distress. And normally, the bond conversion of CoCo is linked to things like the capital ratios that I mentioned earlier. The Tier 1 capital ratios going beyond a certain level. That means that the bond will then convert into shareholders' equity, which by becoming shareholders' equity will actually improve the Tier 1 capital ratio, because there will be a bigger amount of shareholders' equity. So that's quite a detailed explainer of this situation. But in this case, Wilhelmina is just fighting back and going all guns blazing at Tender. But I don't think she'd want the conversion of the bond. She'd want to call the bond to get the bond repaid.
That was Burgess?
Mm-hmm.
Big story in the tabloids tomorrow, front page. The Serious Fraud Office are announcing their investigation in the afternoon.
Yeah, the government's just mandated a Section 166 skilled person review into Tender's compliances and risk controls. The FCA are instructing PwC.
Stocks indicating to open down 77%.
No one wants to catch the knife.
So in this scene, they're talking about a Section 166 skilled person review. And what this means is, this is typically where the regulator, and in this case it's a UK term, where the Financial Conduct Authority, or sometimes the Prudential Regulation Authority, which will be the Bank of England, requires an independent third party to review specific aspects of a regulated firm's business and report back. So it's essentially someone going in saying, is there some serious fraud going on or something that we should be aware of? And it would be a pretty serious issue if you were given a Section 166 skilled person review.
Tomorrow morning, we hit the tape small, don't show our hand, and exit as efficiently as we can. Show me dollars.
So, I hope that was helpful to go through some of the jargon and terminology in this episode of Industry. Things are certainly hotting up and it looks like it's an end game for Tender, but who knows if they can pull out a rabbit out of the hat. You never know in these series. But I hope you enjoyed watching, and watch us next week when we'll do another review.